Joining us for a further look at what's playing itself out in the market scene is Thamsanqa Netha from Shiloh Capital. Thamsanqa, thank you for your time and a good afternoon to you.
Afternoon.
Hi, Thamsanqa. Keen to get your thoughts on what we are seeing playing itself on the markets. Yesterday was actually a bit of a red close. We are seeing an attempt at a fight back today, but still not quite where I would say we could be, considering the kind of month that November's been.
Yeah, I think it's a key element around the resource producers. The miners are actually going through it now. There's a lot around their commodity pricing, how they operate and value that. So there's a lot of back and forth around that. I think volatility is the name of the game, given what's happening across the world right now. I think we're going to bear the brunt of some of that, especially around the commodity cycles as well as the currency. But I think all in all, end of the month well, our companies are performing well and they're producing great results.
I'm also ask you about maybe markets possibly kind of waiting for that inflation print coming out of the US to give it some form of conviction for the week. Is that a possibility?
Yeah, I think it's not so much the market looking at the inflation numbers. The knowledge that the Fed is going to respond aggressively against high inflation. So the inflation numbers are an indicator of what the Fed will do. Right now, interest rates are pretty high. And if there's an inflation number that comes below the target, the Fed might hold or even ease further. If that's the case, then markets will definitely rally. So right now, the view is that inflation indicates towards the Fed. The Fed has held the line quite strongly around ensuring they're targeting inflation. So has our Reserve Bank. They've been quite firm around inflation targeting. And inflation numbers then become an indicator of where what the decisions are going to be made by our central banks globally.
Just staying with the US, I'm keen to get your thoughts on conversations around IPOs at this point. I'm sure you've heard of Shein looking at an IPO. That's a bit unexpected sometimes. We're not seeing a great stock market around the world. The Magnificent Seven has really been the boost for the US market there. But Shein looking like they're soldiering ahead with this one. I'm keen to get your thoughts on the market conditions right now and whether they are fit for an IPO of the size.
Yeah, sometimes IPOs are not driven necessarily by the current market conditions, but they're driven by internal factors such as funders, venture capitalists, options for shareholders, options for employees. So a lot of the time they are in the money and need to get out at that point. Same sort of scenario happened with Airbnb, where a lot of the employees' options were about to mature and they need to take action. So sometimes an IPO is pushed not necessarily by a macroeconomic trend, but by what's happening internally with the company, which I think is happening this year.
Very, very interesting dynamic you're painting for us. I'm also keen to get your thoughts on Nampak. Now, of course, we know Nampak has been on this deep restructure. We thought that I thought that it would be looking at a better Nampak. And now that they've managed, to get a new CEO in, a fresh perspective on the debt. But it looks like they've been hammered this reporting period. I'm keen to get your thoughts on that one as well.
Yeah, changing the driver doesn't change the car. The business model is fundamentally what's in trouble right there. They're selling a product which is very hard to manufacture. It has costs. They can't control the macroeconomic conditions around the cost of that product. And then you have to look at the customer who's buying the product and how are they viewing what they're producing. So you can change everybody in the company, but the business model is what needs to change. They need to look at how can they adapt to where they are currently, and how can they change to make sure that the business is sustainable. Otherwise, it's going to continue to suffer going forward.
And then let's touch on Ascendis now. Of course, we heard about these news a while ago, but I think they're back in the spotlight now because I think there's some developments there. We are seeing the CEO in a consortium to buy Ascendis and delist. I'm wondering, it is a related party transaction in my mind, and I'm keen to get your thoughts actually, on the blurry lines that could exist in something like this.
Yeah, they could, but you could also call it a management buyout, which is fair. I think the real damage to Ascendis was done by the excessive leverage. I think they had great assets, but way too much leverage. At this point, the company is now quite sizable for a management buyout, and that as long as the shareholders vote for it, it will work out for them. But I don't know if it will drive value. Don't know if it will actually lead to debt recovery. And maybe we might see it in a few years back on the market. But management buyouts are normal. The management come together and they structure a consortium to buy it out. The key issue is, do the shareholders feel there's conflict? If they don't, and they feel they'll get some value out of it, then the vote will happen and they'll succeed in the ballot.
We're watching this one very closely. Before we move on, ArcelorMittal South Africa. It's been a tough time for the steel industry. It's been a tough time for manufacturers in South Africa. I know at some point when I was younger, this was one of the biggest companies in South Africa, Thamsanqa, you know. But it really has been one thing after the other. Now that we're seeing 3,500 jobs on the line, are we surprised at all by these developments here?
No. Firstly, they're a very big company. They're a very big shareholder. That's the first. The second, which is they really rest on construction demand globally, which has tempered quite badly, especially in China. So the consumers of steel, as we often say, you can't outperform macroeconomics. It's a very difficult thing when you don't have the demand for your product, and that's where they die. And I think until there's some form of alternative demand, or they begin to address new markets which are building, constructing, or demanding steel in one form or another, I think it will continue to be quite a tough place for them. And unfortunately, when you look at a business, when you can't grow the revenue, you have to reduce the costs. And one of the biggest costs they face is labor. So they're going to have to take that decision. And this is something we're going to see, I think, across the board, where demand is soft, especially on the commodities and mining side.
Now, Thamsanqa, I'd like us to move in to stock picks, but first I'd like us to reflect on counters that have found a favor with your industry peers.
I'm going to say cash. I know it's boring, and I haven't done it in a while, but for right now, after the move we've seen, I'm happy to be a little bit on the sidelines as at today.
It's a competitor to Bidvest in the Bidcorp in the food supply market to the restaurants industry. So it's trading at relatively attractive valuation after a recovery in their earnings post-COVID. So yeah, I'll go with that. I think it's a good quality business that is very defensive.
Perhaps a brand in any way in all the business. I think that the CEO, Ari Rottenbach, is going to continue to execute well. I mean, he's a strong operator. We saw a good update from Standard Bank today, and Absa also has the South African franchise and Africa exposure. I think that they're already on an 8% dividend yield, and I think they'll grow earnings kind of 8% this year, so it gives you about a 16% return, and then possibly a bit of a re-rating if we see South African macro GDP numbers improving next year.
All right, I'm keen to get your thoughts on some of those. I mean, we do have counters, but we also have cash. It's a very interesting one at this time of the year.
Yeah, I think given the volatility, you want to be liquid enough to take advantage of great value opportunities, but you also want to be liquid enough not to take the risk on holding equities that may not necessarily have a strong focus going forward. I think modes will begin to matter quite significantly. And businesses with that kind of strength will attract capital.
And which counter are you going with this afternoon, Thamsanqa?
Sibanye Stillwater. I think there's great value there, and I think it will continue to show good value going forward.
Thank you so much for your time. It's always a pleasure hearing from you. That was Thamsanqa Netha from Shiloh Capital with your markets update.